Hi folks, welcome to this video now. Second part of the question we were doing, and we just finished doing the integrated foreign operation, assuming that the functional currency being used by the sub was that of the parent company. Now what we did in that time and that period of time in the first video is we reviewed the rules for translation. We also calculated on the income statement some of the key accounts like cost of goods sold and depreciation and operating expenses. And we also calculated the exchange gain or loss. And in our case, we calculated an exchange loss, which is going to be part of net income. So now what we're going to do is we're going to prepare the income statement, the statement of retained earnings, and the balance sheet under the assumption that the sub is integrated with the parent. So now, in this case, we can see for the income statement, we're taking it right from the subsidiaries statements. It's 3.15 million Russian rubles. And again, because we do not know the historical rate for each sale, we are going to use the average rate, which is 28.09. And if we divide it, we come up with 112,139 translated. You remember, cost of goods sold was made up of three different rates. So we can't point to one. So I just put CALC for calculated because we had calculated or used a bunch of different rates. One rate was the rate for beginning inventory, and one was the rate for ending inventory. Don't forget, for non-monetary items like inventory, we're going to be using the historical rate, which is the rate in effect at the date they were purchased. Purchases, again, you'll remember, were translated at the average rate because we didn't have a historical rate. So again, we used three different rates, and you'll recall we came up with 59,845. Depreciation on the building, again, we knew that that was 105,000. That was given to us in the question, as was the depreciation on the equipment. The different thing about the depreciation on the equipment, however, is that we had equipment that was being depreciated, and there were two different items that were purchased at different points in time. So we used different rates to calculate depreciation expense. We came up with 2244 for depreciation expense in the equipment, and on the building there were no new purchases of buildings since we became related, so we're going to use the historical rate, which is the rate in effect at the date they became related, and that's 28 to get 3750 translated. Again, we talked earlier about our other expenses, which are 672,000. Remember, this differs from the amount that we had of 840,000 in the question, because these amounts up here, the 105 and 63, that was the amount for depreciation expense that was included in other expenses. Why we pulled them out was because these are translated at based on historical rates, and what's left in expenses, those other expenses, that's translated at the average rate. So we'll come up with 23,923 for that, plug in our exchange loss, and we will get totals for these expenses, cost of sales all the way down to the loss, of 89,631, such that when we deduct it from our translated sales, we'll get 22,508. Now we're going to use that obviously when we calculate our ending balance of retained earnings, so we can use it in our statement of retained earnings. So you'll see from the question our opening balance of retained earnings is 470,000. Well, again, that's the sub's opening balance of retained earnings, and that was earned before we became related. Regardless of the rates that were used prior to the relationship, we have to translate it the historical rate, because that opens the period for which we're calculating retained earnings at the end of the period, but it's also the date they became related, January 1, year 11. So we'd use the historical rate at the date they became related, which is 28. We've already calculated our net income, so we can deduct from that our dividends. Don't forget, dividends declared are deducted from our retained earnings. And again, we're going to use the spot rate for dividends, which is 28.20, because they were declared at December 31st. So that's going to leave us with an amount of $15,957, and that leaves us with a balance and retained earnings of $23,337. And we'll use that ending balance of retained earnings when we calculate our equity section of the balance sheet. But for now, let's just have a look at the balance sheet itself. At December 31st, year 11, we're going to take items that are monetary, like cash, accounts receivable, accounts payable, miscellaneous payable, and bonds payable. And notice we're using the spot rate, which is exactly what our method says to do. All monetary items are translated at the spot rate, and that's what we've used here. Notice our inventory. Our inventory is going to be translated at the historical rate, and that would be the rate in effect at the date the ending inventory was purchased. And they give us that in the question. They tell us that's 28.04. Now, for our land and our buildings, again, they pre-existed the relationship. However, we're going to use, because they pre-existed the relationship, the rate in effect at the date we became related, which was 28. And our equipment, you'll recall when we did our calculations in the first video, you'll remember we calculated equipment at $17,222. And again, I have a CALC here, calculated, because we had two different rates for equipment. The rate for the opening balance in the equipment for the sub at the date we became related, and there was also a historical rate that we used to translate the equipment that they purchased during the current year, year 11. So this 17,222 is a composite of two different rates that were used to translate the 483,000. Similarly, those same rates were used to translate 168,000 in accumulated depreciation, and that gives us total assets of 86,141. Now, we've talked about our payables. We do need to talk now about our common shares and retained earnings. Our common shares in the question are 850,000. We already calculated the ending balance of retained earnings up here, which was 650. All right, and to translate them, we know the common shares, we use the historical rate. And that's 28 because the shares that the sub has were issued before we became related. So they'd issued these shares to their shareholders before we became related, or to the shareholders before we became related, and that would have been 28. And again, our retained earnings translated to 23,337. That's up here. So now we have 86,141, and we have a balance sheet that's balanced. So the next thing we're going to do in our third video is we're going to look at preparing our exchange gain or loss to go into OCI as well as the statements, assuming that the functional currency is that of the subsidiary company. Stay tuned.